Statistics show that 25% of new businesses in the transportation and warehousing industry fail in their first year. 35% fail by their second year, and 60% fail by their fifth year. The most common reasons small businesses fail are lack of capital, inadequate management, and poor business planning. So how do you avoid being one of the casualties? In part, by understanding that all three of those factors are linked to knowing your cost of operations. It is critical for you to know your costs and to continually search for ways to reduce or control those costs. Why? First, the lower a carrier's costs are, the easier it is to make a profit. And second, a business can make money but still fail because their costs are beyond their income. To go into a little more detail, without understanding your cost of operations, how will you know what you need to earn to stay in business? Controlling your cost is often more profitable than gaining new business. Always remember, this is not a money-made business, it's a money-saved business. If two carriers receive the same rate, the carrier with the lowest expense is making the most money. And if a carrier lives on the edge of their income, meaning if their income only covers their cost and a little more, it will eventually catch up with them. That's especially true if they encounter unexpected expenses, such as health issues, market or regulatory changes, or an accident. To understand how much it costs you to drive your truck down the road, you need to break down your overall costs into two distinct segments, fixed and variable. Let's start with fixed costs. Fixed costs must be paid regardless of miles or income. These include truck and trailer payments, insurance payments, plates, permits, and so on. Fixed costs are more challenging to reduce. However, you can take some actions to control or lower them, such as being practical when purchasing a truck or trailer. Maybe you should consider a used truck rather than a brand new truck, which can be extraordinarily expensive. Being realistic when deciding your scope of operation, such as where are you going to run, regionally or in all 48 states. Being careful in choosing what insurance coverage you need, what you should have, and how much they cost compared with other options. And being aware of potential problems if you decide to use a line of credit, and we'll address that later. That can include higher interest rates and severe penalties for late payments. Also, consider your return on investment regarding these costs. For example, look at the expected fuel economy on the truck you purchase. Consider your actual needs when you spec a truck to purchase and decide, do you actually need a trailer? Will you lease on to a carrier that will pay you more for using your own trailer, or is a drop and hook operation better for you? Now let's look at variable costs. Variable costs fluctuate according to conditions. They are costs a business has more control over. They include fuel, meals, tolls, tires, repair and maintenance, and perhaps most important, paying yourself a living wage. Most companies will seek to control their expenses by decreasing their variable costs. That can be done through items such as aerodynamics, which can increase fuel economy, learning low fuel usage driving techniques, which can save more fuel than virtually any device added to the truck, having a portable refrigerator so you can avoid eating out and instead plan meals, which may end up being healthier for you, mapping out alternate routes to avoid tolls, saving money on tires through such things as a discount program, using retreads or intense maintenance to extend their life, and engaging in preventive maintenance, which can extend the life of your engine. However, it is important to consider the return on investment here as well. Will the item pay for itself and help the carrier become more profitable? And how quickly will the carrier receive a return on its investment? One final note about capital and its relationship to the cost of operations. Because it is critical to have adequate cash flow, you should consider cash on hand. An owner-operator should have 60 days or more of cash on hand to cover ongoing expenses, and a line of credit. Establishing a business line of credit can help in emergency situations. A line of credit enables the borrower to take out money as needed until the borrowing limit is reached. That way, the borrower only owes interest on the amount they draw, not the entire credit line. Once you have a full understanding of how to calculate your cost of operations, you can use it to arrive at other figures that will help you run profitably. Two important figures are the net profit margin and the operating ratio. The net profit margin, also known as a contribution margin, compares the revenue received per mile with the cost of driving the truck per mile. The first thing you need to know is what is commonly called the break-even point, the point at which costs and revenue are equal. The margin is the difference between where you are and that number. A positive net margin indicates you're making a profit. A negative net margin indicates you're losing money for every mile you run. So use the net profit margin to determine how much you need to earn for each mile you operate. To calculate the net profit margin, you need three figures: gross revenue, or how much you are paid per mile, fixed costs per mile, and variable costs per mile. Then use simple math. Gross revenue minus fixed costs minus variable costs equals net profit. For example, let's take a case of one owner-operator. Let's call him Bob. Bob is offered $1.80 a mile to haul a load. He knows his fixed costs are 38 cents per mile and his variable costs are 92 cents per mile. So Bob takes $1.80, subtracts 38 cents, and then subtracts 92 cents, arriving at 50 cents per mile, his net profit margin per mile from that load. Now, Bob not only knows what his net profit margin is for every mile he runs, he can also figure out how much more he can earn if he decreases his cost of operations. What if Bob wants to know his net profit margin as a percentage? That can be useful too, because it lets Bob know how much money he'll get to keep for every dollar he brings in. So, it's back to basic math. Bob takes his net profit margin per mile, 50 cents, and divides that by his total revenue per mile, $1.80. That gives him a figure of 0.27, which he multiplies by 100 to arrive at the percentage 27%. That means that for every dollar Bob brings in, he'll have 27 cents to keep after he pays all his expenses. The other useful figure you can calculate using the cost of operations is the operating ratio. The operating ratio shows how much of your revenue is being used to cover your operating costs. This ratio is a percentage that can be used to show how much more money you can make by reducing your expenses and measure how efficient you are at keeping your costs down. How does it do that? Well, the smaller the ratio, the more efficient the carrier is at generating revenue versus total expenses. A high operating ratio indicates that expenses are increasing in relation to revenue, while a low ratio indicates that either expenses are decreasing, revenue is increasing, or some combination of the two. Calculating the operating ratio is pretty simple. You take your total operating expenses, divide by your total operating revenue for the same period of time, then multiply by 100. Operating expenses divided by operating revenue times 100 equals operating ratio. If the operating ratio is below 100, our owner-operator, Bob, is making a profit. The more successful larger carriers will have an operating ratio around 90. Owner-operators will want to keep their operating ratio around 75. In other words, an owner-operator like Bob needs to make at least 25% net profit or better to succeed. For this example, we'll use Bob's figures for 1 month. Bob spends $10,500 every month on average, and he earns $15,000. So he divides $10,500 by $15,000, arriving at a figure of 0.70. He multiplies that by 100, giving him an operating ratio of 70. And right around 70 means Bob is doing pretty darn good. There are other ratios to consider when calculating your cost of operations. These can help give you a more accurate and complete picture of what an owner-operator will need to start and maintain a successful business. These are discussed in Truck to Success. Ultimately, the cost of equipment, supplies, fuel, and materials are constantly changing and can have a huge effect on an owner-operator's cost of operations. With this information, an owner-operator now has more power to negotiate or renegotiate their rate because they have a target to shoot for.